I think the most important thing, everyone likes to talk about stocks, but in the next 3 or 6 months, it's going to be all about the bond market.
Welcome back to week 2 of Crash or Boom, where Real Vision investigates what's happening and what may be an inflection point in markets with some of the biggest names in finance. I'm Ash Bennington. Today, we have Andreas Steno Larsen with Bob Elliott, CIO of Unlimited Funds. Let me set up the context for you. We've been talking about this all week. I hope you've been enjoying this in series as much as I have. Harris Kupperman and Louis Gove talked about a secular energy crunch, the return of volatility, and secular growth in EMs ex-China. Then we had Rick Rule and Tracy Schuchart talking about energy markets and policy disconnects from the laws of supply and demand, and indeed, the laws of physics as well. Yesterday, I spoke with Jeff Dorman, CIO of Arca. It's really interesting to hear how a CIO thinks about the crypto markets at the highest level, talking about things like infrastructure, some of the challenges with allocation in the digital asset space. It's always great to have Jeff on the show with us, and it's something different from the typical kind of in the weeds crypto conversation. If you're not 100% on board with crypto, this is probably a good one for you to start to just get a sort of 50,000 foot overview sense of how these markets work. And one of the smartest thinkers in the space, I think you'll really enjoy it. With all of that said, Andreas, over to you. I'll be back at the end of the show for some question and answers.
Thanks very much, Ash, and welcome to the show, Bob. It's always a great pleasure to host you here at Real Vision, and what a tremendous timing for a discussion on macro and markets, given all of the central bank meetings that we've had this week. I'd like to start with a brief summary of your takeaways from both the skip or pause from the Federal Reserve yesterday, but also from the Bank of England today. What are the pros and cons of not doing anything here, Bob?
Yeah, well, thanks so much for having me right here in the central bank bonanza. I like to say here doesn't get more exciting than this for the macro set. I think what we're seeing at the big picture level, sort of known as we were coming into this, was that the major developed world central banks are looking for a reason to pause. They really think that. I think they're wrestling with the question of the trade-off between weakening growth and inflation. I think we're getting a good sense as to what their reaction function is and what their priorities are. And the short of that, in terms of their priorities, is that they're willing to stop tightening not just before it's certain that inflation's coming down to their mandates, but before it's even obvious that we're moving meaningfully in the right direction. And so what we're seeing, but a little less from the Fed, a little more from the Bank of England, the ECB, and some others, is that they're prioritizing their concerns about growth ahead of fulfilling their inflation mandate, and are comfortable with a dynamic where even in the best of circumstances, inflation is moving back down to mandate, let's say, in 2 years, and they're okay with that. So all that speaks to a set of central bank activities, at least, in the medium term, let's call it 3, 6, 9 months, that are going to be comfortable with elevated inflationary dynamics across these economies.
Before we went on air here, Bob, I made a heat map of forward pricing of all of the major central banks across the globe. And over the next 12 months, the Bank of Japan is the most hawkishly priced central bank on earth. Then something is wrong, right?
When's the last time that happened? Probably 1989, right?
Yeah, it's got to be decades back at least. But if you look at the prospects for further rate hikes from the Fed, Bank of England, maybe even the ECB, do you think there is a path ahead for them where they can actually decide on rate hikes again, despite this pause rhetoric that they've used over the past couple of meetings here?
The short answer, I think, is no. I don't think that those central banks, in a time frame that those of us who trade markets really care about, are going to move to tighter monetary policy. I think, they've basically made their bed when it comes to saying that they're, at, or maybe there's 25 basis points more or something, but I don't really care about that. What we care about is, are they going to meaningfully re-enter a tightening cycle anytime soon? I think the answer is no. They think they've done enough. And frankly, they're making a big bet on the fact that the disinflationary forces and the work that they've done so far will eventually get inflation back down to their mandate. Now, I think the thing that's interesting about that from a trader's perspective is what that does is it puts a lot more weight on the long end of the curve. And that's exactly what we're seeing. Typically, if you were, if you go back to the 07 cycle or the 2000 cycle, when the central bank stops tightening, when you get that pause, that would typically be a good indication to buy bonds, right? Because the central bank is no longer essentially dragging up the yield curve with their activities. But as we've learned in the last couple of days, it's exactly the opposite, right? Bonds have been selling off despite the fact that these central banks have paused, and even in some cases sort of dovishly paused relative to expectations. And the reason why that is because the fact that they've paused before we've meaningfully gotten inflation down to mandate or close to mandate means that the inflation problem still exists, right? The risk of the inflation problem still exists. And what that means is that the long end is repricing that dynamic. Like, the worst thing for the long end today is that central banks don't tighten aggressively. And the best thing is that they do. And that's a little counterintuitive, but you can see it in the market action. That's the reality of what we're seeing. And so, it's up to the long end and the market-based tightening to get the job done right now.
A bit of anecdotal evidence to add to your point here, Bob. After the Bank of England hiked by 50 basis points in June, we saw a drop in market rates across the entire sterling yield curve. And after they paused and decided not to hike interest rates today, even the very short end of the sterling yield curve actually moved up. So your point is spot on. And I guess it's related to sort of the market reaction function in an inflationary environment. So, Bob, how does this alter asset allocation, broadly speaking? Now that central banks, at least in the eyes of the market, will allow inflation to run harder than what is the target or what is demanded, how does that alter asset allocation across assets here?
Well, I think the challenge is that most investors have some version of 60-40, whether they like to admit it or not, right? That's essentially what their exposures are. And, what is 60-40 particularly good at? When does it outperform? It outperforms in an environment where, there's disinflationary strong growth. And instead, what we're sort of seeing here is an environment of, inflationary weak growth, right? Look at the UK, unemployment is starting to rise. Growth is, 0 or a little bit worse, but core inflation, 6%. Look at the US, it's clearly moderating, but inflation remains elevated. Europe, basically the same story. And so if you're in that environment where you're holding, 60-40 or something related to it, it's not a great environment. And particularly, like what we've all learned, over the last few decades, is that bonds are a good diversifier to stocks. And that's exactly the opposite of what's happening. And it's a little bit like, how many times do you have to get slapped in the face with the fact that bonds are not a good diversifier for stocks before you finally learn that that is the case? And again, day after day after day, that keeps coming in. So what is a good diversifier? Well, I think part of the opportunity set is to look for other assets like commodities and gold. Like, it's not actually that unusual. Gold outperforms bonds in 60% of equity drawdown periods. That's, but how many people hold gold in their portfolios? I mean, like literally I start talking about gold and people's eyes glaze over and they think I'm a crazy person, right? But everyone holds bonds, but why would you hold bonds if 60% of the time they're the worst asset to hold as a diversifier to stock drawdowns than is gold? And then, the basic question here is, given the uncertainty, do you increase your allocations to cash relative to assets? Now, that's a tough trade because typically assets outperform cash. Those folks who loaded up on cash earlier this year are licking their wounds as 60-40 and diversified asset portfolios like our have done pretty well. So you have to be a little careful about that. But that's the other option, is to reduce your risk given the uncertainty in the market.
Everything in this interview is about how we can eventually profit from this uncertainty, whether we are in a booming scenario or in a recessionary scenario for the year ahead, Bob. And I'd like your take, now that we talk about diversifiers for portfolios, I'd like your take on energy as a diversifier as well. As far as I can see, it seems like it holds true diversification effects relative to the rest of the market as well.
Yeah, I think energy is a good asset to hold in addition to the assets like gold. Diversified commodities typically do well in these sorts of environments where the central bank is behind the curve on inflation, and so probably is going to be a beneficial add to a portfolio, but also runs the risk that assets can underperform cash, and we're sort of seeing that today a little bit in the last couple of days, that commodities may be okay but may not survive this challenging environment.
Hey, sorry to interrupt again. It's Raoul here from Real Vision. I'd love for you to subscribe to the channel, get the notifications. We have so many incredible conversations with so many amazing people. It will really help you in your financial journey and your journey to understand just what the hell's going on in this world. Anyway, click subscribe, get the notifications, and enjoy.
Bob, I have to give you a hat tip up front for the way that you've kept saying that the recession was not around the corner throughout the entire year. You said it in early January when everyone and their mothers were stuck in recessionary discussions. And now I have the sense that you've started to turn around a little bit on your view from a risk-reward perspective, Bob. Am I right that you see a recession as a likelier scenario for 24 than you did earlier this year?
Yeah, well, I think when we trade markets, the basic thing you got to start to think about is what is likely to happen relative to what's priced in. And I think people too often forget the what's priced in part of things. You got to start with what's priced in, and then you can go to what you think will transpire relative to that. And I think what we're seeing, what we saw at the beginning of the year was that basically everyone was pricing in the expectations of a recession. There were some models a year ago that said there was 100% probability of a recession within a year, which is kind of funny, right? Since that didn't happen. And so, that's the basic dynamic that's been priced in, that was priced in, a year ago, didn't transpire. That's a big reason why asset prices actually did pretty well over the period. Well, now, I sort of, when people were bandying about, the Atlanta Fed GDP now measure of 6%, and everyone was saying, oh, there's no way we're going to get into a recession anytime soon. That's exactly the time when you might start to ask questions about whether there was, whether we have the probability of a recession, a year later with the tightening that we've had is certainly a lot higher than zero. And with the market, the equity markets are pricing in 12% earnings growth next year and 13% earnings growth in 2025. That's very high, elevated earnings growth at a time when the inflationary pressures are emerging, the recessionary pressures are emerging. The U.S. economy is slowing down. There's no question that there is some moderation in the U.S. economy, and you should expect that to continue further. So it's really that gap between what's likely to transpire and expectations that's really the most interesting part of this overall dynamic.
Bob, if we look across assets right now and look for clues on whether bonds, equities, commodities, etc., are priced for a recessionary scenario, let's start in the fixed income space. We still have a yield curve pointing towards cuts, especially in the second half of 24. But is a recession priced in already in fixed income space, given your view on the price action in the far end of the yield curve as well here?
Yeah, well, I think what's priced into the yield curve, and I think across a bunch of different yield curves, is more soft landing vibes than recession. You're getting, now we're getting the moves that we have a couple of cuts priced into 2024, 3 cuts as of the end of the day yesterday. That's not quite enough cuts to be reflective of recession. And not enough and too many cuts to be reflective of too many cuts to be reflective of a strong growth or an inflationary dynamic. Now, I think the real challenge here is the most likely path that we're going to see is we're going to see these inflationary dynamics emerge, continue. We're going to see these central banks be, I guess, pausing for longer rather than hiking higher or hiking longer. And so that's probably first going to create the environment where those cuts that are priced in, those modest cuts are priced in, are going to get priced out. And then what's going to happen is that the rise in the long end is going to create the hit to asset prices, which will eventually turn the economy, which will eventually make the long end a more interesting place. And so, the idea of trading December 25s long versus short December 24s, say in the US context, is, one of the more interesting dynamics right now. Because, that's kind of where in the curve where the two mispricings exist in the curve.
If we look at the ramifications for the broader economy of the yield curve as it looks right now, Bob, it seems like the US economy is at least not as sensitive to interest rates as it was in 06, 07, likely as the duration of liabilities has increased since the great financial crisis. So what do you make of the yield curve in relation to the interest rate sensitivity of the broader economy here?
But it's basically, I think there's two things it's saying. One is it's the yield curve, and particularly the significant inversion in the yield curve, was kind of reflective of the fact that people thought that and still kind of think that the economy is very sensitive to that short end, and that the fact that the Fed has raised the short end will eventually mean that cuts will come, but the bond market and particularly the short rate market has kind of been wrong. It's been deeply wrong on that point over and over and over again in the last 18 or 24 months. And so I think that's sort of the fundamental mistake that's going on, which is like, given the restructuring of the U.S. economy following the financial crisis, the sensitivity of corporations and households to rising rates, particularly on the short end, has gone down a lot. And so, for most households, if, mortgage rates are 7 or 8%, doesn't really matter. They've already locked in their low rate. The same thing is true for corporations. And so I think people have overpriced the sensitivity. They've looked at something, they've said, hey, look, it's how many times have we heard the fastest tightening cycle since, forever. And you look at it and you say, no, but you have to get down to the nuts and bolts and the pieces. And how does that tightening cycle actually work in the US context? And the answer is it's not having much effect on most folks. And so instead, the way this economy and the way this market is going to slow down is through falling asset prices, which are going to create a slowing of demand and a rising savings rate. But the way that has to work is not through rising long rates, which, the long rate and the discount rate is embedded in all financial assets. That then starts to hit stocks. A rising long rate hits stocks, like the market action we're seeing right now, right? Except we need probably, 50 or 75 basis points more on the bond side of things and maybe 15% more on the stock side of things to start to make a meaningful impact on the economy and start to create that slowdown. And so that's kind of the dynamic that we see. We have an asset, what I like to say is like, we have an asset price problem in the US. We don't have a price of credit problem. We have an asset price problem because of the low sensitivity of the economy to those interest rates.
Bob, if we look at an interesting part of the fixed income market, the so-called inflation-protected market. We already get questions on that particular part of the market relative to our discussion on an inflationary environment with low growth. So what do you make of the TIPS market as a diversifier or as an addition to a portfolio, given your view of high inflation relative to growth here?
Well, first of all, I love that we're having a conversation about tips. I mean, it doesn't get any better than talking real interest rates. That's not the sort of usual conversation that folks are thinking about, but it's good because I think let's first just talk about how you think about tips, which I think is important, particularly in an inflationary dynamic, because I think a lot of people are sitting here looking at it and they're going, "Wow, break-even inflation is, I don't know, it's basically stuck at 2%, or so close to 2%, and it's not really moving around, despite the fact that we're getting this inflationary dynamic. Kind of how can that be?" And the answer is, if you've traded the tips market, it's important that to see that there's two ways an inflationary dynamic can resolve itself. The first way is that break-even inflation can rise, and that's certainly one of the ways. And that mostly what you see nominal yields rise more than you see real interest rates. But the other way it can resolve itself, particularly on the long end, is that if there's expectations of elevated inflationary pressures over a long period of time, the way that can get resolved is the central bank can respond through elevated real interest rates, right? So if you can get that 2% inflation outcome, that basically is being priced in the market, as long as real interest rates are held higher for longer, and that's essentially what we're seeing in this market is a real circumstance where real interest rates have risen a lot. The inflationary pressures have led to elevated real interest rates, not really that elevated break evens, and that those real interest rates I think reflect the reality that we probably need higher real rates for longer, and that real rates, let's be honest, at in the mid twos, in 2.25, 250, you're starting to get something that has real value in it, that you might not see in the nominals. Like if I, just for perspective, like the greatest tips trade happened right in the middle of the financial crisis, and tips were at 325. So, I mean, that gives you a sense as to long dated tips were at 325. So, we've gone a long way from where we were in terms of, tips being negative yielding to being yielding into the twos. As you get up to the 2.5 range, you start to get very attractive long-term returns coming from those securities.
Looking at real rates of, say, 2.25 or 2.5, even further out the curve, Bob, we typically have a discussion as well around risk premiums in equity space at such a juncture, right? And various measures of risk premiums of equities are at decade lows, and we probably even need to go back to before the great financial crisis to find similar gauges of or levels of risk premiums. So what do you make of the equity space in relation to these elevated real rates?
Equities are really expensive. I mean, there's really no beating around the bush on that. We have, if you just think about it from an equity perspective, let's just say, I don't know, let's call the S&P 500, at 20 times, give or take, right? That's a 5% yield. Well, if you look at other points in the capital structure, I know you talked about real rates, but I like to start, look at other points in the capital structure. Let's look at, I don't know, bank loans, right? Slightly lower credit quality than the S&P 500, but still top of the capital structure when you get your secured bank loans, and those are yielding 10. So the question is okay, but in order to be indifferent between holding bank loans and holding stocks, bank loans yield 10, stocks yield 5. How much earnings growth are you going to have to get in order to be indifferent between those two, right? Because stocks have a lot more volatility and are low, the lowest point of the capital structure. I think it starts to raise real questions about why would you go for equities in such an environment when such relatively significant earnings growth is priced into the equity market, when there are other yielding opportunities that are out there that are giving you something that is in some cases as high as double digits for things that are in the B's in terms of credit quality. And so I think real rates are just another extension of that, which is why would you if I can get essentially a guaranteed 2.5% real return, to be clear, with zero risk, right? That's, the if you buy TIP and it's yielding 2.5%, like on a real yield basis, you will get 2.5%. That is a guarantee, right? You will get 2.5% real. That's how it works with no risk. Like, how good do equities have to look over long periods of time? What are equity real returns? They're more like 5%, but you take on, 16% volatility. Is it really a good trade-off? I think these are the types of questions, the capital structure questions, that investors are going to increasingly be asking themselves. And increasingly the answer is stocks don't make sense relative to all these other opportunities, these yielding opportunities in the market.
Bob, if we look at the price trends over the past, say, 6 to 8 weeks with improving price action in oil, improving price action in several industrial commodities, and also improving price action, at least if we look a few weeks back, in cyclical equities relative to defensive equities. I know that the trend has turned a little bit on that one. It seems like there is some kind of narrative brewing in the market that there is a cyclical upswing on its way here. At least it is tempting to make that conclusion. So if we look into 2024 with these price trends in mind, do you find any reasons to believe that we could get a further cyclical upswing in risk assets here?
I think it's gonna be tough, and the reason why that is that it's pretty tough to get. Well, I should say, I think it's going to be tough, but you got to start with what's priced in. And so, if you look at something like cyclical stocks, growth stocks, stuff like that, like extraordinarily good outcomes are being priced into cyclical stocks and growth stocks. I think the story, so it's going to be pretty tough in that environment, particularly since so many of them are long duration in nature, in an environment of rising interest rates, an environment of slowing economy. That sort of constellation of pressures is not a very good pressure for cyclical stocks, particularly given how elevated the pricing is. I think the commodity complex is a little more complicated because you got to roll up your sleeves and think about all the supply and demand dynamics that are going on. If Saudi Arabia was pumping at full capacity, then I wouldn't, the commodity, for instance, oil, wouldn't necessarily look great in the context of a globally slowing economy. But that's not how it works. You have to think about who are the producers and what are they doing. And the Saudis and OPEC Plus cutting back on supply has created a purposeful squeeze on the oil price and created, greater balance to somewhat, from a price perspective, a bit of a deficit, combined with the fact that essentially paper money, the futures folks, the hedge funds, are getting squeezed, having held big short positions in these commodities. Like you sort of put those dynamics together. And oil can certainly, and a little to some extent, other industrial commodities can trade in a way that kind of feels cyclical, but it's really sort of idiosyncratic in terms of the supply and demand in those particular markets.
Makes a ton of sense, Bob. If we look for great risk reward opportunities in a market environment with rising inflation, or at least inflation way above target still, and a slowing economy, Bob, where would you look and how would you construct ideas in such an environment? Because we've kind of made the conclusion that equities are not super sexy here, bonds not super sexy here. So do we have anything to buy here? What are the risk rewards?
Is there anything? Can we find anything in the market to buy? The pain and struggle of a long-only investor shrinking that right now. Well, I think there's a couple things. I think when you're looking across the market, I do think that there's a real opportunity. I sort of mentioned, like these things like bank loans, preferreds. I know these are like very annoyingly boring corners of the market. There are no high-flying NVIDIA tech stocks, but like value in yield, right? Where are there opportunities where there's value in yield? that exists, right? And particularly, taking credit against, floaters and things like that, credit and floaters. That's the sort of stuff that, has really, everyone's sort of drawn to the high flying stocks, but there's a lot of these things where you can pick and choose what you're doing. Pretty good credit quality, pretty high yields, 10, 12%. That sort of stuff is the most interesting stuff, I think, that from a long only perspective, honestly, that's in the market. But you got to do your homework on it, right? You can't just buy any old, private equity LBO financing that's going to go broke anytime soon. So that's part of the story, is where are those opportunities, where is there a good risk reward in terms of the yield and the credit quality that you're seeing. I think the other part of this, which many people, we really haven't lived through this since the '08 period, is that these are the sorts of environment where trend and tactical alpha really would typically perform well. And if you think about it, we basically have this circumstance where the economy, equity pricing, et cetera, we're sort of standing on a bit of the edge of the cliff, and these sort of gentle nudges moving us closer and closer to the cliff. Whether it's rising interest rates or government shutdown or just the flow through the tightening that we've seen so far, we're sort of like someone's kind of gently pushing the economy and markets towards that cliff. And the way these things typically work is that once you start going, once you fall off the cliff, you keep falling. And so these are environments that can actually be quite attractive to use trend strategies in order to help make yourself a little more balanced, a little less long only, and a little more balanced in the market, and you'll be able to sort of tactically respond as you get these sort of self-reinforcing dynamics, either on the long end of the bond curve or in the equity market.
Mm-hmm. Bob, if you look at positioning right now, both among what I typically label as real money players, so pension funds, asset managers, etc., and then hedge funds, do you see any strong signs that markets have started to fear the recession again in positioning here?
Well, I think how do I say this? I think when you look at the long only managers, what you see is that there's still a lot of duration that those folks are holding. And is that a value? I think it's probably more a value play than a recession play for those. Imagine being a bond manager for the last 15 years, and your baseline expectation is the long end yields 1.5%, and you're like, oh my God, 4.5%. It's like Christmas. Buy bonds, buy bonds, right? The trouble was they were saying that when yields were 375 and 350 and et cetera early in the year. But anyway, I think that's more of what's driving the dynamic. And I think if you listen to the talking heads when they get on television on a regular basis, they'll all say, this is the greatest opportunity for bonds that we've seen in our lifetime. And then I think until those folks capitulate and start to really recognize that the value on bonds may not be what they think it is, I think that's the time that eventually you'll start to see that positioning flip. You'll start to see those asset manager bond positions start to come off and equity positions to some extent. And that's really the sign of the final capitulation that will drive the final rise in bond yields that will then set us up for the other side. And that's why you got to be so tactical in this sort of moment, right? We've all sort of we've learned over the last 15 years, just keep buying stocks, just keep buying stocks. We're in choppy waters. We're going to be in this really tough turn that's going to be very hard to time. And so you've got to remain very agile in these sorts of environments, because the ordering matters. Yields go up, stocks go down, yields go down. That's a hard set of things to navigate as an investor.
It sounds like, Bob, that a curve steep in a trade could be the optimal first trade in this kind of environment before we get to the next leg, at least if we need to see that the long end of the yield curve being sort of the release valve of all of this. So what do you see as the main drivers of this steepening of the yield curve in coming quarters?
Yeah, I mean, I do like the curve steepener, and I mean, partially because it speaks to this dynamic of the central banks in general, taking the easy, sitting on the sidelines, and then getting most of the work being done on the long end. So I do like that part of it. I think the curve steepener also has the benefit that we all must recognize in this business, and folks like you and I have been around long enough to have made a few errors in our day, recognizes that we can also be wrong, right, about what's going on, which is a real risk, and that the economy might engage in a downturn faster than we might expect, which could easily create that steepener. But instead of the bear steepener, the bull steepener, if central banks respond relatively quickly to any sharp weakness in the economy or a credit event or things like that. And so I think that's kind of the interesting thing is like, I see a couple of different ways in which the steepener protects you on sort of both two plausible outcomes that I think both of which are a bit underpriced given the inversion of the yield curve right now.
Keep the questions coming in. By the way, Ash will host a Q&A session with Bob during the last 15 to 20 minutes of the hour-long show here. Bob, a steeper, maybe just for the sake of the broader audience, is it tradable? And how does one construct such a steepener view? Is it relevant to look at various points at the curve? How would you go about such a process?
Yeah, I mean, there's a lot of different ways that you can trade the steepener. Like, I'm a simple guy. I like 2s and 10s, good enough for me. You could trade those in the futures. There's plenty of liquidity in that, clear pricing and stuff like that. So that's typically how I'd look at this, is kind of 2s and 10s. If you wanted to trade, say those, I don't know. I mean, part of what could be most interesting given the way that now we're getting weedy here, which is good. This is the nuts and bolts of how you construct trades, and you have to think through these things. If you look at the SOFR curve, we basically have flat pricing through June or July next year in terms of expected no expected easings, and so that might be a way to go. Like you kind of go long at that point in the curve, which could be beneficial in the event that there's like something breaks in particular in the short term. I think the risk that curve shifts higher, meaning that the Fed tightens really at all between now and then, is pretty low. And so I think that's probably a pretty good point of the curve to be long, right in there. And then, you can sell the long end, you can sell a 10-year future or whatever, which is close enough. And that doesn't get you. The problem is with the 2s, you also have what's priced into the that easing that happens in the second half of 2024. It's priced into the second half of 2024. That may come out, which could actually be bad for 2s. And so maybe you target something on the long side in the summer of next year.
Makes a ton of sense, Bob. If we look at price action, but also market pricing of recession risks outside of U.S. borders, I'm talking in particular about European and Chinese assets here. In case of such a, say, global recession scenario, is value to be found outside of the U.S. here, Bob?
Well, I think when you look across the global economy, and you look particularly about how assets are priced, like let's be frank, like U.S. assets are priced, I don't know, 50 to 75% higher than they are in the rest of the world. You look at equity yields. What do you get? Like the MG ETF yield is something like 8%, and what's your yield on U.S. stocks? 4.5, something like that, 4.5 to 5. That means that you got to believe that U.S. equities are going to have radically better earnings growth, in the medium term in order to make the trade-off to overweight U.S. stocks to make sense. And so, I look at how are equity markets priced in China. I mean, they're quite, real weak conditions are priced in China. Maybe things could be worse. That's certainly possible. But like, you have a situation where you have, P's that are running in 11, something like that. And you have surveys that say that everyone, every asset manager thinks that the Chinese economy is never going to open up and never going to grow again. It's possible that that's the case. But the trade-offs, the skew is certainly a bit to the upside relative to that set of expectations in asset markets and sentiment. And then Europe, I think the challenge with Europe is the momentum's not great because the European economies are slowing down more, particularly Eurozone is slowing down more rapidly than in the US, but it's also priced to be terrible. In terms, you're getting pretty good yield, or UK equities, which are really global in nature, but skewed to the commodity sector. You're getting, PEs that are in, again, the low, 11, 12, something like that. It could, those UK listed companies could be a lot worse than the ones in the US, but, all of those sort of speak to the fact that US exceptionalism is priced into the market. And the odds that U.S. exceptionalism persists are not nearly as high as what's priced into the market. That's all there is to it.
This has been a widowmaker view over the past 10 years, Bob. And I have traveled with such a view quite a few times as a sell-side strategist in banks. And it is a somehow easier view to take as on the sell side than on the buy side, I think. Whether you agree with that.
I like that.
But I perfectly agree with your assessment. I mean, it is evident that the European economy is priced for a much worse scenario than the US. It is evident that the Chinese economy is priced for a much worse scenario than the US. The question is just whether you want to bet against the US anyway. And right now, I'm probably not willing to, even though I admit to the pricing being as you described it. But before I leave you for the Q&A session with Ash, I'd like your take as sort of a concluding remark to this discussion on a boom or a recession and how you profit from it, on how to, across assets, map whether a recession is priced in. What's your thinking on how to do it across asset classes? And is there a bulletproof methodology in terms of how to assess these recession risks and to which extent they're priced in?
Yeah, I mean, the main thing you've got to do is you got to look. You got to start with what's priced into each one of these markets, and the way you do that in the bond market, or really it's in the short rate market, is to look at that path of expected interest rate changes, particularly in that sort of first 2 years, to sort of understand what's priced in there. And very valuable to look at. To really look at what is priced into expected earnings growth in terms of earnings growth in the next year and the next 2 years, to really understand how those what the expectations are there. I think typically if you look at the like the FactSet Earnings Insight or something like that, and look at the analyst expectations, those are typically a little bit elevated. So, you have to take a little bit of a haircut around that. But you sort of put those pieces together, and what you see is you try and create essentially a connected narrative, right? And that's really what you have to do, because you can't really quite understand the motivations. The pricing is just the facts. And then the question is, what economic scenario could plausibly create that pricing, and what's the likelihood of that scenario? And so, like right now, what you see modest interest rate cuts over the course of the next, couple years, and you see very, very elevated equity earnings growth expected, and you put those two things together, and it kind of looks like everyone's pricing in a soft landing. That's basically what the scenario is that would achieve those outcomes. And so that's kind of what you have to do, is to kind of look at the facts, but also then create the narrative.
It was a tremendous pleasure discussing these recession risks with you, Bob. I will leave the floor to Ash Bennington for the Q&A session.
Andreas, always fun. Great to catch up.
Hi, Bob. That was fantastic.
Hey, how's it going?
It's going well. That was fantastic. I get to hang out in the bullpen for 45 minutes and watch that interview and think of questions to ask you. I mean, it's just a really compelling conversation. And it really does feel, based on your remarks, that you think we're at kind of something of an inflection point here, having this conversation, obviously, after the hawkish hold yesterday from the Fed. It's an interesting moment. We got a lot of great questions from our audience. I just wanted to jump in and start with this. This first one from William: how high do you expect the 10-30 year rate to rise? So he's asking about the long end of the curve. What do you ultimately see being the direction of those rates over the longer term?
Yeah, and I think I don't know how much people heard, but I'll start again at the term premium, which is typically you'd expect long end rates to trade at a higher yield than the cash rate. And I think what we've seen, we basically have about as negative a term premium as we've had in a very, very long time. And so the idea that while we're late in the cycle, which might lead people to expect to have cuts, in the medium term, we could easily have a circumstance where long end rates start to move up, let's say, closer to on par with short end rates, which would be, something like 50 or 100 basis points of further elevation. And if you think about that from the perspective of how it might affect broader asset prices, particularly stock prices, something like a 550 bond yield would probably hit stocks in the range of, 10 or 15%, which is about what's necessary to start that sort of negative economic dynamic playing out. And so something in that range is where you start to see, I think, value in the long end, but we should also recognize there's a lot we don't know. And so it's a little bit, feeling the markets as they're playing out.
Talking about feeling the markets and doing a little bit of a broader, deeper dive into this question, one of the phrases that we've been hearing most recently is this notion of higher for longer. Obviously, with the dot plot moving up yesterday in terms of the expectation of rates remaining higher for longer periods of time. One of the questions that came up, and there's a terrific piece in the Wall Street Journal last night by Greg Ip, asking the question about whether or not the natural policy rate, the neutral rate of interest, has in fact increased. These are a longer term dynamics, things like population, supply, and demand of capital. But the question on the table, and I've read it raised elsewhere, is have we seen a shift in the fundamental neutral policy rate? This is the rate at which it's neither expansionary nor contractionary, the rate at which inflation and unemployment remain stable over time. Have we seen a change in that variable, sometimes called R-star by economists?
Well, I think it's a confusing question, because if you look at the fundamental drivers of R-star, which is meant to be long-term, the long-term interest rate pressures, we're in an environment where you'd actually expect long-term neutral rates to be falling. And the reason why that is demographic deterioration combined with elevated debt levels should portend lower neutral interest rate in an economy. And at the same time, what's happening is the Fed just keeps hiking rates and the economy doesn't seem to be slowing down. And so they're sitting around going, I'm talked to a few Fed economists in my day, and they're sort of sitting there going well, I don't understand what's going on. Our models are saying it's going down and the reality seems like it's going up. And the issue is, first of all, R-star is kind of a stupid concept because it's not that useful in setting monetary policy. What is useful is understanding what needs to happen in order for the economy to slow down. And I think what we're seeing is the fact that that the lack of sensitivity, tactical sensitivity of the economy to interest rate hikes means that the effective interest rate that creates a meaningful slowing of economic growth is higher than most people expected, right? And so that's not R-star. That's not the neutral 30-year interest rate. That's what's the interest rate the Fed needs to deliver today. And so I think that's the most relevant question when you're thinking about it. And the answer is higher, right? Meaningfully higher than most people expected.
Yeah, and you're right about this sort of this open question about the usefulness of the concept of R star. It's something that can kind of only be extrapolated based on actual inputs and actual outputs. So really, what's the relevancy when you can actually look and say, hey, okay, the actual rate is at X, and these are what we're seeing in terms of the variables we care most about, specifically employment, inflation.
Right, and I think that this is my. Don't listen to the economists, the academic economists. It's not that useful. Like, the thing that people you should listen to are people who are economists who have money on the line, who have learned the practical realities, how to think about it. So yeah, sure, there's hundreds of economists sitting around trying to, fight which academic paper is smarter than the other, sounds smarter than the other one about R star. But the real thing that matters is, very practically, how is this economy working, and how are these interest rate hikes flowing through? And that's really, as investors, focus on that. Stay away from the academic discourse.
That's very funny. All right, next question comes from David Sims. Bob, what's your view on the U.S. dollar? We should say, obviously, DXY right now up over 105.
Yeah, it's been the dollar has, despite all the claims of the death of the dollar here, it continues to be relatively strong. And those of us who've been trading currency markets for 20 years have been hearing that for a long time. So every time you hear the death of the dollar, just remember, people have been saying the same thing for they've been saying the same thing for 40 years. And
the reasons are always good. The logic is always,
the reasons always feel good,
right?
But it's in the land of the blind, the one-eyed man is king, and that is really what the dollar sort of structurally is all about, right? It may be ugly, but it is the least ugly, right. Certainly long-term investable asset in capital markets across the world. And so I think, putting aside those things, when you start to think tactically about the dollar and relative monetary policy conditions, I think what we're seeing that the U.S. and its lack of sensitivity to interest rate hikes and its stronger economic conditions are putting us in a position, putting the U.S. in a position where it can run, stronger growth and tighter monetary policy than many other places in the world. That probably will persist in the sense of, Europe is probably weak. Europe is weakening a little bit more than the U.S. and the UK as well. And so some pressure on those European currencies on a forward-looking basis makes sense. And similarly, Japan, the next time Japan will have 5% interest rates, 5.5% interest rates, I think we'll probably all be dead. So, probably not something to worry about there in terms of Japan, really getting on their high horse and tightening monetary policy meaningfully on par with the U.S. And so, the U.S., the dollar is, the pricing is relatively elevated. The U.S. still looks like it's an advantageous position. And so, of all the assets that are out there, the dollar is kind of maybe it trickles up a little bit. It's not that interesting a trade right now. A lot more interesting stuff going on in the bond markets, I think.
Yeah, this is kind of the least dirty shirt in the pile of laundry.
That's right.
Yeah. So talk a little bit about bond markets and what your view is there, where you see the most opportunity. I know that Andreas covered some of this already, but you talked about this concept of value and yield. Where do you see the most value in yield?
Well, I think the most value in yield, the picture of short end yield is pretty attractive, particularly when you compare it with credit style, with some credit, maybe moderate term, 1-2 year, investment grade corporate, or higher up in the capital stack type assets where you can start to get a trade-off. Like in the event that you get a spread expansion, you're probably going to get some cuts get priced in, and those two have some nice negative correlation benefits in there, and you're not as sensitive to sort of the pressure on the long end and the duration supply. I think that's kind of, and there's a bunch of different ways to look at that. There's preferreds, floater preferreds. There's, bank loans. All of that stuff is the sort of stuff that has modest credit risk relative to a relatively elevated yield. And in this environment where there's not when essentially risk premia seem compressed in a lot of different places, you kind of want to find those corners of the market that just haven't gotten the type of cross asset flow that have really bid them up meaningfully. And so I think those are the sort of areas that are the most interesting in the yield space.
Yeah, it's interesting. You said that to a certain extent, the value may not be there in terms of what people perceive as the value in the bond market. You also make the point of how pricey stocks are right now. S&P trading at a PE of around, I think, about 22. I'm wondering, what else do you allocate toward? Is there a sense, you mentioned gold and energy. Do you have a particular play in the energy space, for example, where you see an especially high degree of opportunity relative to the risk and volatility?
Well, I don't really trade individual names. I'm sure there's got to be some good, I don't know. There's probably somebody drilling in Canada that makes a lot of sense and has nice convexity to oil price rises. It's been a long time since I've been through that, down in the details of that. So mostly I'm trading macro assets and asset classes, and oil still has still has some positive convexity, although that is fast eroding as we get almost to the triple digits in prices in terms of upside growth potential relative to what's priced in. It's a tough. This is the problem: is we sort of go through all these asset classes like bonds, long end bonds, term premium seems too low. Stocks, earnings are priced in, earnings growth is priced in to be too high. Commodities, oil at 100 looks a lot less interesting than oil at 70 in the 70s. Gold has outperformed bonds by 60 or 70% over the last few years. So, starting to raise questions about it, whether it's still going to continue that outperformance. So it's a tough to be a long only guy in this environment.
Yeah. Here's a question from Lena. I don't know if I can answer this one, but the question is, what is the best way for retail investors to position gold? And then she also asks, does Bob have any opinion about Bitcoin?
So on gold, I trade gold. You can trade futures if you're a big enough size. You can also trade IAU. The ETFs are good, good enough, highly liquid, tight bid-ask spreads, reasonably cheap in terms of operating. They're a little less tax. They're a little less tax efficient than you might like, but that's how it goes when you're trading gold, given the tax structure of it. Bitcoin, my 30-second background on Bitcoin is that I, back in my Bridgewater days, led Bridgewater's research on Bitcoin, went through, got a good understanding of the asset, and basically said, this looks nothing like my sort of macro considerations and the macro drivers that I understand. And so, I'm just not going to trade an asset that I don't understand the fundamental macroeconomic properties of. And I still basically hold that view today, which is, I'm sure there's lots of very smart thinking about Bitcoin and what's driving it. I just don't. It's just not mainly driven by macroeconomic drivers in a time frame that at least I'm trading at. And so,
right.
I just you don't have to trade everything. That's the most important thing to recognize as a trader. You don't have to trade every market. You don't have to be in the market every day. You should trade the things where you have an edge and where you see good risk return opportunities, and so it's okay. You don't have to trade everything.
I think one of the smartest answers can just be, I just don't have a call on that. It's just outside.
I just don't understand it well enough to be able to feel like I've edged. That's all there is to it.
Yeah, very well said. Bob, great conversation with Andreas. We really appreciate you joining us. Obviously, you guys covered a tremendous number of topics. Final thoughts, key takeaways that you'd like to leave our audience with.
Well, I think the most important thing, everyone likes to talk about stocks, but in the next 3 or 6 months, it's going to be all about the bond market. And how that plays out is going to drive basically how asset prices evolve in the medium term. And in that sense, the ordering really matters. While we probably will get to a recession, across the developed world economies, the ordering really matters. That first, yields are going to have to rise. and asset prices and stocks are going to have to fall before we get to the opportunity that it makes sense to start to buy bonds. And so keep that in mind. Don't get ahead of it. You'll get burned, and stay nimble. This is going to be an exciting 3 or 6 months coming up.
Exciting in the sense of the old Asian curse, may you live in exciting times.
That's right. There certainly will be interesting times. No question about
it. Bob, thanks so much for joining us. We really appreciate it.
Yeah, thanks so much for having me. It was great fun.
Great conversation. Listen, before we wrap here, I also want to mention a conversation that Raoul Pal is having with Beth Kindig tomorrow on Real Vision. I got a chance to get a little bit of a sneak peek of an early cut of this, and it's really just fantastic and interesting stuff. It's a conversation mostly about AI, its effects on the tech industry, tech investing, and how, according to Beth, it's the biggest investment opportunity of our lifetimes. I found this an interesting perspective. You know, most folks who are analysts come to this from the financial side, and then they learn the tech piece. Beth did it the other way around. She was a tech analyst out in Silicon Valley, assessing various technologies from M&A activity and other corporate actions. She developed a really deep understanding of the way the technology worked. She was also long NVIDIA far before this massive run-up that we've seen in the price of the equity. I think it's going to be a great conversation. Check it out tomorrow on Real Vision. Thanks for watching, everybody.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.